This is the start of the supplemental homework or practice problems for Chapter 2. 2-1 is a series of true-false questions. Part A says a corporation may deduct 30% of their dividends paid if the dividends are paid to another corporation. This is false. Dividends paid are never deductible. They're never tax deductible. We say dividends are paid out of after-tax dollars after our tax liability has already been calculated. Then we make the dividend decision and we don't go back and refigure our tax situation just based on whether we pay dividends or not. In Part B, if a corporation's capital losses exceed its capital gains during a year, then that corporation may deduct the net capital loss that year. That is false. Corporations don't deduct a net capital loss in a given year. They might be able to carry it forward or carry it back to get some tax benefit from a different tax year. But if the capital losses exceed the capital gains in a year, there's a net capital loss that year, they don't get a deduction for it that year. Part C says if a corporation's capital losses exceed its capital gains during a given year, then that corporation will never receive any sort of tax benefit from that net capital loss. Well, that's not absolutely true. They certainly might receive a tax benefit, such as through a carryback or a carry forward that I mentioned previously. Part D says if a corporation receives dividends, which would obviously come from another corporation, then the recipient corporation may exclude 70% or more of the dividend income from its taxable income. That is true. For our purposes, we will use 70%, but it could actually be more than that. So a corporation will never be taxed on more than 30% of its dividend income under current tax law. Part E says if net working capital increases, then cash flow from assets decreases, everything else equal. I'm going with true on that. We could think about that a couple of different ways. Something that would cause net working capital to go up, such as some sort of current asset. When a current asset increases, then we know that cash decreases. They're inversely related, indirectly related. Another way to convince ourselves of this relationship is cash flow from assets is operating cash flow minus net capital spending minus the change in net working capital. So if something causes net working capital to go up, then cash flow from assets would go down. We're tying up cash in net working capital form, thus it can't be paid out to our investors if net working capital increases. Part F says if accounts payable increases, then cash flow from assets decreases, everything else equal. That would be false. One way to think about this is accounts payable is a liability. In fact, it's a current liability. And when liabilities go up, then cash is affected in the same direction. An example, accounts payable here going up is that our suppliers are basically loaning us more money by extending us credit terms. So if we owe them more money, we're conserving our own cash and our cash flow is actually increased. G says if operating cash flow exceeds net capital spending plus increase in net working capital, then the firm was able to pay cash out to its investors. That is true. Since our cash flow from assets is operating cash flow minus net capital spending minus the additional investment in net working capital, then I'm talking about the net capital spending and increase in net working capital combined. So if the operating cash flow is greater than the sum of those two components, the cash flow from assets must be positive in that case, meaning the investors would have received cash from the firm. 2.2 says, what two preferences do preferred stockholders have over common stockholders? Well, one is the preferred stockholders have a priority to receive dividends each year. In other words, preferred dividends need to be paid prior to common dividends being paid. And then if the firm is liquidated, then the corporation must settle up with the preferred stockholders prior to paying anything out to the common stockholders upon liquidation. Question 2.3 says, to use the following data to determine the amount of dividends ABC paid out during the year. Retained earnings started at $1.8 million, ended at $2,500,000. The net income was $800,000. Well, we know that the net income gets divided up among dividends and the addition to retained earnings for the year. So I can see that retained earnings increased by $700,000 during the year. So my $800,000 net income, $700,000 of that was retained inside the firm. Thus, the firm must have paid $100,000 in dividends during the year. Problem 2.4 asks us to compute the following for a firm with $240,000 in taxable income. First, the marginal tax rate. Recall that our tax table looks like this. These are marginal tax rates. Our $240,000 of taxable income would fall within this range on the fourth line of the table. So 39% would be the marginal tax rate that would apply to our $240,000 of taxable income, because the $240,000 falls in that 39% or fourth row of the tax table. To calculate the effective tax rate, I have to first calculate the tax liability for the firm. The tax table shows us the first $50,000 of taxable income is taxed at the 15% marginal rate. The next $25,000 is taxed at 25%, and the next $25,000 is taxed at 34%. So let me exhaust those first three rows of the tax table here fairly quickly. The first $50,000 is taxed at 15% on the first row of the table. The next $25,000 was taxed at 25%, and the next $25,000 was taxed at 34%. So I have those amounts of taxes on each of those portions of the taxable income. At that point, I've taxed the first $100,000 of taxable income. I need to tax a total of $240,000, so that leaves me to tax $140,000 on the fourth row of the table at 39%. So 39% of $140,000, which again is just the portion to be taxed on that in that fourth row. So $140,000 taxed at 39% results in $54,600 of taxes on that $140,000. So our total tax bill on the entire $240,000 that we had to tax is the sum of all of those portions there. So I add those up, and I get a total tax bill of $76,850. My average or effective tax rate is obtained by dividing that tax bill by our taxable income of $240,000, which means on average we're paying 32.02% as our average or effective tax rate. Because overall we're paying almost $77,000 in taxes on the $240,000 in taxable income. 2.5 says ABC has operating cash flow of $1 million. It increased current assets by $400,000 and accounts payable by $300,000 while investing $300,000 in new fixed assets. What was ABC's cash flow from assets? Let's start by getting the change in net working capital, and then we can bring up the cash flow from assets equation all at one time. The change in current and net working capital is the change in current assets minus the change in current liabilities. So in this case, current assets went up by $400,000. The only current liability we know about is accounts payable, which went up by $300,000. So net working capital increased by $100,000. Now our cash flow from assets is our operating cash flow minus our net capital spending minus our additional investment or change in net working capital. So with our $1 million operating cash flow and our $300,000 net capital spending, along with our $100,000 additional investment in net working capital, then we see that our operating cash flow from assets was $600,000 for the year. Problem 2.6 asks us to first calculate XYZ's operating income, or EBIT, earnings before interest and taxes, for year one. So we'll start with the revenue of $1 million. We'll take off our cost of goods sold, which is $500,000. And that will get us down to gross profit of $500,000, from which we need to subtract our cash operating expenses and our depreciation expense. So we have cash operating expenses of $200,000 come off, and depreciation expense of $100,000 to come off, which brings us down to an EBIT of $200,000. In Part B, it asks us to compute XYZ's taxable income, and it gives us a little help here. It says to take our EBIT of $200,000 and subtract the interest expense, because interest expense is tax deductible. That would get us to what typically we call EBT when we are not faced with any dividend income or anything like that. Our typical income statement would have EBT, which is EBIT minus the interest expense. But we're told we also need to add the taxable dividends on there. With the 70% dividend exclusion applying here, we're going to tax 30% of that dividend income of $150,000. This is a corporation, and it is going to be taxed on only 30% of its dividend income, or $45,000. So its EBT, $120,000, plus those taxable dividends of $165,000 would give us the firm's taxable income. And then Part C asks us to calculate the tax expense using that table on the course notes. As we saw before, we tax the first $50,000 at 15%, the next $25,000 at 25%, and the next $25,000 after that at 34%. We need to tax a total of $165,000, so that leaves $65,000 to tax on that fourth row of the tax table at the 39% rate. At that point, we will have taxed the full $165,000. So 39% of that $65,000 results in taxes of $25,350 just on this fourth row. So the total tax bill for this firm is $47,600. If we wanted to calculate the effective tax rate, we would just divide that by the $165,000 taxable income, and that would be 28.85. Average or effective tax rate. It didn't ask for that, but when we have the tax bill, it's not hard to calculate that result. Problem 2.7 asks us to calculate ABC's operating cash flow for year one. Operating cash flow is our operating income, EBIT, earnings before interest and taxes, is also called operating income. Plus, we add back our non-cash depreciation expense and then take off our taxes, and that gives us operating cash flow. So with the EBIT given to be $800,000, I'll add back the non-cash depreciation expense of $400,000 and then take the taxes off, which are $225,000, and that results in operating cash flow of the $975,000. Again, take the operating income, add the non-cash depreciation expense deduction, and then take off the taxes. In problem 2.8, it says to compute ABC's net capital spending given the following. Well, since this is net fixed assets that we're given, then I see that the net fixed assets increased by some $200,000, but I know that net means net of the accumulated depreciation. So the firm's depreciation accumulated against its fixed assets increased by $350,000 during the year. So that was their depreciation expense for this particular year. So before they depreciated the net fixed assets for the year, they had $1,750,000. Before they took off the $350,000, they had $1,750,000. So they went from $1,200,000 up to $1,750,000. So I would bet the net capital spending is going to be $550,000, because before they depreciated the $350,000 here, they were at $1,750,000. You get from $1,200,000 to $1,750,000 if you purchase $550,000. Well, the net capital spending equation from the textbook says to take the change in net fixed assets and add back the depreciation expense for the year, which again is that increase in accumulated depreciation is the same as your depreciation expense for the year. Our net fixed assets went from $1,200,000 to $1,400,000. So that's a $200,000 increase, as well as that $350,000 depreciation expense lowered the net fixed assets down. So the firm must have purchased $550,000 in fixed assets during the year. Again, the change in the net fixed assets was $200,000, and before they recorded the depreciation expense, it would have been $550,000 above where it began for the year. So that was the net capital spending or the amount invested in fixed assets for the year. Problem 2.9 says if a firm pays dividends of $200,000, pays interest of $400,000, issues $1,200,000 worth of stock, and repays $1,800,000 of debt, what is the firm's cash flow from assets? We could calculate the cash flow to stockholders and the cash flow to creditors, and then the cash flow from assets would be the sum of the two. So the stockholders receive dividends of $200,000, and we also need to reflect the fact that the firm issued $1,200,000 worth of stock. That is something the stockholders would have had to pay cash into the firm when that new stock was issued. So the cash flow to stockholders from the stockholders' perspective was actually negative. The stockholders paid $1 million into the firm. For the creditors, they received the $400,000 in interest expense, and the firm repaid $1,800,000 worth of debt. From the creditor's perspective, when the firm repaid the $1,800,000 of debt, the creditors received the $1,800,000. Thus, the creditors had received a total of $2,200,000 from the firm during the year. So the cash flow from assets would be the sum of these two, the minus $1 million cash flow to stockholders plus the positive $2.2 million cash flow to creditors, results in $1.2 million cash flow from assets. The investors received a total of $1.2 million during the year. The creditors got $2.2 million, and the stockholders paid in $1 million net during the year. Problem 2.10 says a firm issues 20,000 shares of $10 par value stock for $50 per share in cash. How is this transaction recorded? Well, one, we know cash is going to increase, so I will debit or increase my cash by the $50 per share times the 20,000 shares that were issued, which is $1 million in cash that the firm will receive. When stock is issued, I divide that up into the common stock account, which is the par value. So the common stock account will have a credit of $10 per share times the 20,000 shares that were issued. So 200,000 goes into the common stock account, and the additional paid in capital is the difference. The stock was issued at $40 per share above par, so 800,000 goes into additional paid in capital, or it's everything that did not go into the common stock account. In problem 2.11, a firm issues $100,000 in stock and repurchases $20,000 in stock while paying dividends of $30,000. In part A, we're to calculate the net new equity raised, and then in part B, we are to calculate the cash flow to stockholders. Net new equity raised is calculated by taking the new stock issued and subtracting stock repurchased. In this case, the firm issued $100,000 in new stock while repurchasing $20,000 in stock. So the difference there of $80,000 was the net new equity raised, or the total amount of stock issued over and above what was repurchased. So $80,000 is the net new equity raised. In part B, for the cash flow to stockholders, that is going to be the dividends paid minus that net new equity raised. So we're given that $30,000 in dividends were paid. In Part A, we calculated that the net new equity raised was $80,000, so we will subtract that. So we get negative $50,000 as our cash flow to stockholders. Now let's think if this makes sense here. The stockholders got the $30,000 in dividends that were paid, but if $80,000 in net new equity was raised, then the stockholders actually pay $80,000 into the firm, and that's why that is a negative. And so the total cash flow to stockholders there is negative $50,000. The stockholders got the $30,000 in dividends, gave up $80,000 for the net new equity that was raised, and that produced a negative $50,000 cash flow to stockholders. Now, I often think it's helpful to go put plus and minus signs on the individual items here from the stockholders' perspective to see if we can come up with this negative $50,000 another way. If the firm issues stock of $100,000, the stockholders pay that into the firm. If the company repurchases $20,000 in stock, the stockholders get that when the company pays them for the stock that they repurchase. And of course, the dividends are always going to be cash received by the stockholders when the dividends are paid. So we have minus $100,000 from the stock issue, plus $20,000 on the repurchase, and plus $30,000 on the dividends. So the total of those would be negative $50,000 from the shareholder's perspective to be the cash flow to the stockholders. Problem 212 asks us to calculate net new borrowing and cash flow to creditors. Net new borrowing is calculated by taking the debt issued and subtracting the debt repaid. So in this case, the firm issued $200,000 worth of bonds and repaid or retired $50,000 worth of debt. So the net new debt issued was $150,000. The cash flow to creditors is interest paid minus net new borrowing. And we see the interest expense was $30,000. We calculated the net new borrowing to be $150,000. So we see the cash flow to creditors was negative $120,000. Now, I like to check that by putting plus and minus signs on these different items here from the creditor's perspective. So if something caused the creditors to receive cash, it's a plus, and if they had to pay cash, it's a minus. So in the case where the firm retires $50,000 of debt, they're paying off the debt, the creditors receive that $50,000. When the firm issues $200,000 worth of bonds, the creditors pay for those bonds, so they give up $200,000 of cash. And when the firm pays the $30,000 in interest expense, then the creditors receive that. So the creditors receive a total of $80,000 and pay in a total of $200,000. So in the net, it is a negative $120,000 from the creditor's perspective. In 213, it asks us how would each of the following affect net working capital and cash flow from assets. Well, we'll need the change in net working capital, which is the change in current assets minus the change in current liabilities. So once we know how something affects net working capital, let's think about how it would then affect cash flow from assets. Cash flow from assets is operating cash flow minus net capital spending minus our change in net working capital. So anything that causes net working capital to increase will cause cash flow from assets to decrease and vice versa. So an increase in inventory, which is a current asset, if it increases, it would cause net working capital to increase, and it affects cash flow from assets in the opposite direction. Cash flow from assets would go down. If we see inventory increasing, we are tying up cash in inventory. Yes, that is an increase of our investment in net working capital when inventory goes up, but it certainly makes it more difficult to pay cash out to investors. So our cash flow from assets goes down when we tie cash up in our inventory account. Part B says a decrease in accounts receivable. Accounts receivable is a current asset, so if a current asset goes down, then our net working capital would decrease, and cash flow from assets would be affected in the opposite direction. Accounts receivable represents what our customers owe us. So if what our customers owe us goes down, that means they paid us for everything they purchased from us, as well as paid us for something that they owed us from before. So that means we are receiving cash. It's easier for us to pay cash out to our investors. So the cash flow from assets goes up when accounts receivable goes down. Part C says an increase in accounts payable. Accounts payable is a current liability. So if this current liability goes up, since it's subtracted, the net working capital would actually go down, and of course cash flow from assets would be affected in the opposite direction. An increase in accounts payable is an increase in what we owe our suppliers. So this is actually us borrowing from our suppliers. That means our cash position is enhanced and we have more cash we could pay out to our investors. Or if you prefer, when our accounts payable goes up, we've increased our current liability, then our total investment in net working capital has decreased, and thus the cash flow from assets will have increased. In 214, it asks us how each of the following would affect the cash flow to stockholders or creditors, and thus cash flow from assets. Well, let's keep in mind, cash flow from assets is the sum of both the cash flow to stockholders and cash flow to creditors. So anything that increases either one of these, causes these to go up, will cause cash flow from assets to go up as well, or if it causes these to go down, then cash flow from assets would go down as well. So in Part A, it says issue new stock. If the firm issues new stock, then the stockholders have to pay cash into the firm, and their cash position is negatively affected, and so the cash flow from assets must have been smaller, and the firm needed to issue stock, and the stockholders had to give up that cash. In Part B, where the firm repurchases stock, then the stockholders receive the cash, and thus their cash flow from assets was greater because the firm was able to repurchase that stock from them, and results in cash flow to the stockholders. In Part C, the firm issues debt. So in that case, then the creditors have to pay for the new debt that is issued. Thus, they give up cash. The firm's cash position must have been lower because it had to issue that debt. So the creditors gave up the cash to buy that new debt. And of course, the repurchase of debt would be just the opposite, that the creditors receive the cash when that debt is repurchased.